And everybody, just like that, the trade war is back in action. So everybody, welcome back. But this time it's due to cooking oil. You can't make this up, cooking oil. So Trump opened up a new can of worms with China today. We've seen markets react. They for sure flipped. The Fed hinted at rate cuts, and Wall Street just got caught between tariffs and treasury talks. So let's unpack today. It really felt like deja vu, like we've been here before, but with a little bit more heat in the pan this time. So stocks, they really were moving up and down today. A lot of volatility in markets as the news just progressed throughout the day. Beijing sanctioned U.S. subsidiaries of a South Korean shipbuilder, accusing them of hurting Chinese firms' interests. But losses narrowed as the U.S. officials downplayed tensions, then flipped again when Trump went back online, and by the close, the S&P 500 fell 0.16%, the Nasdaq slid 7.6%, the Dow managed to inch up 0.44%, but this one was the kicker. The volatility index climbed through the roof this session because traders have seen this movie before. We've been here. Threats, panic, diplomacy, repeat. So it like escalates, then it de-escalates, and then it just kind of repeats its cycle. And what I seen today, I was trying to make a few trades, and right here, let's just pull up this one chart and look at it real quick. This is the QQQ, the Nasdaq 100, and I just kind of seen it. You see this little pattern right here? Right there. So I was trading this one and it kind of broke through, so I sold and took the L on this one, but I literally sold at the top, and then literally, you can't make this up, it fell all the way down. So bad trade on my part, but as you could see, today was just a lot of moving up and down. And then if we back out a little bit, you could just see the last few trading sessions are just wild as far as market moves are going. And it's because this is an event traded market. So literally every news line, every hint at data, because we're really not even getting data out, the idea of earnings, it's really spooking people out. And then Trump, my man Trump, came out here and he made a post on Truth Social that he called China's refusal to buy U.S. soybeans an economically hostile act. I thought the verbiage was a little weird and said that the U.S. might cut off cooking oil imports entirely. And this is after the threat of a possible 100% tariff by November 1st. And like I said, this is in addition to that mess. Then Trump went on to say we can easily produce cooking oil ourselves, he wrote. And as far as market moves, investors are getting wise in reference to the pattern. Like I said, this escalation, de-escalation, then back gain, then back down. It's a mess, but this time the credit markets might be the real concern here because everybody loves a good taco. Trump always chickens out. We've been here before. It's kind of like deja vu, but this is where it kind of like twists and took its own turn. So JP Morgan reported $170 million in charge-offs tied to the collapse of the subprime auto lender Tricolor. And charge-offs, this is this banking term. You might have not heard of it because unless you've charged off an account. But a charged off a bank account is an account that's been negative so long they're not getting it up to current. After a while, the bank just goes ahead and takes their loss. They shuts the bank down, the bank account down, and you just owe the bank that balance. So Jamie Dimon didn't necessarily like what he's seen with that. His words were, when you see one cockroach, there are probably more. And he warned the long-term stretch of benign credit could be ending, that could be going behind us. CFO Jeremy Barnum added that growth is slowing and the labor market is getting softer. Things are fine now, he said, but they're not guaranteed to stay great forever. And then we also heard from Jerome Powell today. So Chair Jerome Powell spoke in Philadelphia, and pretty much what he told us is he's making it clear another rate cut is likely later this month. He admitted the Fed is navigating without a risk-free path right now. If they cut too fast and inflation might stay sticky is something they consider, but if they move too slow, they're aware of this. Job losses could spiral. So they kind of got to like pick which one they want to deal with. And Powell's made it clear his last few press conferences that it's the labor market the Fed's worried about, and we could probably expect to see the 2 more rate cuts this year at the October FOMC interest rate decision and the December meeting. He also hinted the Fed's balance sheet runoff, its $6.6 trillion portfolio may be nearing the end. Its end. And in translation, the Fed could soon stop draining liquidity from the system, which is seen as a good thing. And with the government shutdown still blocking official data, Powell admitted we'll start to miss that data if this goes on much longer, making it even harder for the Fed to look through and make their predictions and forecasts. They have their way about still seeing certain types of data and running their own models and forecasts. So I wouldn't say they're completely in the dark, but from the public point of view, they don't know what the heck's going on. And then the IMF weighed in today with their own warning that 2026 could be the year when the trade war's real costs begin showing up. So growth is expected to slow from 2.8% this year to 2% as the effects of front-loaded consumer spending and business spending begin to fade, as people really jumped ahead of spending to avoid the tariff bumps in increase in prices. So by now, you don't have to pay the tariff costs later. So they're saying that spending is going to really ease off, because when you think about it, when everybody already front ran tariffs and already spent the money, they're happy. They got everything they need. So higher tariffs and fewer immigrants could also stoke wage inflation and slow productivity in the labor market, putting the Fed in an even tighter corner. Then we also seen this fund manager survey today. I don't know if this was today or yesterday, but it was from Bank of America's Global Fund Manager Survey. And what this one really revealed to us is that we entered the week the most bullish. Fund managers entered this week the most bullish they've been in 8 months. So right before Friday's 2.7% sell-off, before Trump reignited this trade war with China, they went in super bullish, and now they're split between betting on AI euphoria or really fearing this private credit crunch or anything else that could arise out of everything going on. And then Goldman Sachs CEO David Solomon, he came out with his own kind of cautious warning, him trying to they got away with things like Jamie Dimon with his 60th warning we got the other day. This is just David Solomon's version. So what he's pointing out is investor exuberance is high, cycles always turn, and Goldman's always, they're already preparing for that in a way. Goldman's already prepping for layoffs. They're redirecting savings into AI-driven efficiency. People are going to be replaced. They're going to lay off about 1,000 workers. So there's just another sign for you. And then meanwhile, we got some U.S. small business sentiment data. And what we've seen from this is small business optimism dropped to 98.8, near its long-term average, as owners cited inflation and hiring trouble as top problems in this current environment. Then, just to top it off, we heard from Boston Fed President Susan Collins. She really echoed Powell's tone today, calling for 2 more rate cuts this year. Her main focus here is that this labor market is weakening, and she warned that further softening could leave the economy vulnerable to such risks. And then Philadelphia Fed President Anna Paulson, she came out and made similar comments yesterday, noting that the labor market is going in the wrong direction and that tariffs may cause only temporary inflation. And together they're signaling one thing pretty clear, which is that the Fed sees the labor market, not inflation, as the bigger risk right now. So between tariffs and cooking oil, I prefer olive oil myself, rising credit stress, dovish Fed talk, and global growth warnings, markets are balancing on this knife's edge between optimism and exhaustion. And Grandpa, I'm tired. And if you haven't seen that video to get the reference, go to Google, type in Grandpa, I'm tired, TikTok or Reel, and You'll see what he says. But if history's any guide, what we're seeing right now might just be another calm before the next trade war storm. So all we could do is watch. I bought some stocks and I sold some stocks and I made a trade and then I got out too early. It's been a mess. But anyways, I hope you're doing all right. I hope your day was awesome. I'll see you tomorrow, everybody. Have a good one.